Welcome to today's seminar. My name is Diana and my goal today is to help you understand life insurance a bit better than you already do and how it can be used to plan for a more secure financial future. This presentation has been provided by AIG. A recording of this presentation will be posted on my YouTube channel, so if you come across this video on YouTube, this is amazing. Please stay with us, subscribe, and give us thumbs up if you like it. On my YouTube channel, I have other videos related to life insurance, so if this topic interests you, please feel free to explore it. Okay, so now before moving on and telling you everything you wanted to know about life insurance, it is worth mentioning a few words about risk. Managing risk is a fundamental part of financial planning. Even the people who are saving, investing, and thinking they're doing everything right can have their financial futures derailed by unanticipated events like an unexpected accident or natural disaster. In this presentation, I will help you identify a few areas of risk and mitigating factors that can help you towards building a more solid financial foundation. Now, let's discuss your options for safeguarding your financial assets through life insurance. Life insurance is an important part of a comprehensive financial plan, as I mentioned, and it protects the people you care about most. Because of the multitude of options provided by life insurance to help you secure your assets during your lifetime and beyond, we'll try to focus the rest of the presentation on your life insurance needs. One of the goals of any financial security plan is to protect against life's uncertainties, and life insurance is often the first item on the list for taking care of family members. However, with disposable income at an all-time low, many families have to make difficult decisions on what financial priorities takes precedence. Unfortunately, life insurance is not at the top of the list for many, and everyday expenses such as energy costs, food, clothing, transportation were cited by more than half of consumers surveyed as limitations on their ability to save for financial goals. Just about everyone could benefit from life insurance. It can protect your financial plan in a number of ways, and you don't have to die to use it. You may be able to tap into your life insurance to deal with unexpected expenses in emergency situation, pay off debt, use it as a collateral to generate the business cash, fund a college education, or replace current income or supplement retirement income. But how do you determine your need for life insurance? Well, if you are considering purchasing life insurance, there are a few questions to consider first. What are my needs? What type of life insurance do I need? How much life insurance do I need? And for how long will I need life insurance? First, you should analyze your life's needs. Most of us have immediate and ongoing needs. This may include income replacement, payment of outstanding debt like a mortgage and so on, education funding, emergency fund, retirement supplement, estate planning, last illness and burial, and then continuity of a family business, and so on. And for everyone, this could be absolutely personalized and could be different. Now, once you determine your life's needs, you can better assess how much life insurance you will need to protect you and your family's standard of living. Usually with life insurance, we're trying to fill in a gap. Where are the gaps you need to fill? That's up to you to assess, or basically what assets do you own that also affect how much life insurance you need. Needs are different for every person. Do you need to build a cash reserve you can borrow against, or is your goal to provide for family members after you die? How much life insurance you purchase also depends on how much you can afford. Also, keep in mind that assets can reduce your overall life insurance needs. If you are considering your needs in retirement, you should subtract the income you expect to receive from Social Security payments, well, if any, and any savings or investments you might have. Working through the life insurance worksheet on the next slide can help you determine how much life insurance you will need and can afford. Next, you will select the best life insurance that suits your needs And keep in mind, your purpose for purchasing life insurance and the length of time you expect to need it are also important. There are two categories of life insurance, term and permanent. So let's look at term life insurance, which provides protection for a specified period of time, such as 10, 20, 30 years, and so on. And it's well suited for short-range goals such as to pay off a loan or provide extra life insurance protection during the child-raising years. There is no accumulation element or cash value. If you die within the term period, a death benefit is paid to your beneficiary. If you're still alive at the end of the term, well, great for you. But due to the terms of this policy, protection ceases unless the policy is renewed. So make sure you keep that in mind. Now, permanent life insurance combines protection for your family with cash value that builds over time. Once it accumulates, the cash value becomes a living benefit that can be tapped to improve your life and meet your goals. Some of its features include lifetime coverage, fixed premiums, and tax-deferred cash value. Now, moving on, the most common types of permanent life insurance would include whole life insurance, universal life insurance, and variable universal life insurance. And let's go over each and every one shortly. Whole life insurance premiums are fixed for life, and the death benefit and rate of return on your cash values are guaranteed. Universal life insurance earns interest at a money market rate. It provides considerable flexibility as to the amount and timing of premium payments, and funds not paying for insurance earn tax-deferred interest. Now, variable universal life insurance allows you to raise or lower your premiums in a single policy and choose how your cash value will be invested. However, since the value of your cash fund is tied to a market value of the assets in the cash value fund, you run the risk of losing your insurance coverage. So you got to be careful with that. And there are two additional types of universal life policies, which include guaranteed universal life and indexed universal life. And you can see the features outlined here. And just to go over this quickly. Guaranteed universal life, this new type of policy with long-term guarantees in death benefit protection and premiums is available for clients who like whole life because of the guarantees. This is basically the alternative, since it provides guaranteed coverage for life, but at the lowest possible premiums. Cash values in this type of policy are minimal, and timing of premium payments is important, but flexibility is available within limits. Think of it as a permanent alternative to term. Now, indexed universal life, flexibility of this type of contract with the upside cash value potential due to performance of one or more indices, but with downside guarantees as to negative returns. So by tying this product to a stock index or 2 or 3, this indexed universal life was built to allow your cash value to increase within limits, of course, when the markets rise, yet protects your account from experiencing negative returns when the markets decrease, as they will go, over time. That's what they do. That's what markets do. They go up and down. Now, the indexed universal life have been built to provide low-cost protection, as well as accumulate cash value to supplement income in later years. So, as you have seen, universal life comes in a variety of choices, whether it is fixed interest, current assumption, universal life, or indexed universal life, or variable universal life, and so on. There are a number of features which are constant. There is an income tax-free death benefit and tax-deferred accumulation of cash values. The cash value growth in any of the permanent type of universal life products occurs when interest is credited. Taking a look at this graphic, you can see that premiums are paid, charges get deducted, cash values accumulate, disbursement can be accessed via withdrawals, and loans and the death benefit is paid tax-free to the beneficiaries. The only difference is how the interest is credited. Cash value increased by either a declared interest rate, interest credited by the indices performance within certain limits, or via performance of the sub-account investment like stock, bonds, alternative investments, domestic or foreign. Now, with the death of a family member traumatically impacting your family, this is a terrible time to add new financial burdens as well. Yet that's what often happens when we don't plan ahead and minimize the risk. Now, what would be the impact of your death or your spouse's on your family finances? Let's work through an example together that will help you see how to estimate your life insurance needs. And this is just one example. There are so many other methods of calculating the life insurance needs. But let's just go and move on and take a look at this example, right? So we'll start by looking at an example of one family's annual income and ability to meet expenses after the death of a wage earning spouse. There is a simple formula we can use to see how much a family might fall behind each year following the death of a wage earner. First, we calculate the family's income each month, to which the spouse who died would no longer be contributing. Then we multiply this number by 12 months that is, to get the total annual income. And as you can see, this is, for this example, this is the annual income. Next, let's consider the family's monthly expenses, and that's very important because every family has its own expenses. And then we multiply the total by 12 to get the family's annual expenses. If you subtract the total annual expense from the total annual income, you can see how much the family would come up short each year. Now, we multiply that number by the number of years you estimate you will need to provide income for your family. This is now the income replacement your family will need in the event you are no longer able to provide for them. Keep in mind that's possible for the family to have a surplus instead of a shortfall, which would mean income replacement might not be a priority for the family. So in this case, looks like it is. Now, also consider that there might be additional expenses and debt that your family could find difficult to manage without your income. And again, this is just like a few examples, but again, it could vary. And by adding together all these long-term income needs and other expenses, you can find your family's total need. So again, this is an illustration, this is an example. It doesn't mean that it applies to you. And again, we are going over an example here. Now, of course, whatever assets the family has available could be used to replace the missing income and cover additional expenses. So we need to look at these assets to see if they meet the family's needs. Here are some additional sources of funds to consider. Current life insurance, cash savings, bonds, retirement funds, and other. And by considering the availability of income and assets versus needs and expenses, you can determine the amount of life insurance coverage that would protect the family against the wage earner's death. These same calculations can be run with the other spouse income to determine the spouse's need for life insurance that would minimize the financial impact of his or her death to the family's finances. Now, how are we doing so far? I think I was going too fast. So if you have questions, please send it over to us during this presentation. We will be glad to answer all your questions at the end of this presentation. So for those who are watching a recording, please comment in the comment section under the video and we will respond. Please remember, I am a resource, and if you are shopping for life insurance or have been thinking about it for a while, please don't hesitate to request help. I love helping people. Now, your need for life insurance changes as your life changes. And I really wanted to mention that because it's very important. One of the main reasons that permanent insurance is so much more expensive is that it's meant to cover you for your entire life, while less expensive term policies tend to cover you when you are younger and least likely to use one. When you're young and single, you might be less focused on acquiring life insurance and more interested in building wealth. At this stage, your need for life insurance may be low, but still exists. You might need it to assist someone who depends on you financially, such as an aging or disabled parent or sibling. Or if you are carrying debt that you wouldn't want to pass on to your family members who survive you, that's when you need the life insurance. And if you're young, healthy, and have a good family health history, your insurability is at its peak, and you can take advantage of the best rates on life insurance. As you take on more responsibility and your family grows, you may need to ensure your family is financially protected in the event of your death. It is also helpful to ensure your children receive money at key stages of their education, even in your absence. If you happen to be a single parent, all responsibility falls on you. Therefore, you need to be even more prepared to safeguard your children's financial future. As you retire or enter your golden years, your responsibilities may once again begin to diminish, and your need for life insurance may decrease. Perhaps you don't have dependents, and your spouse will have enough income to live on from Social Security, pensions, and other assets you might have. However, life insurance may assist in supplementing your retirement income and medical expenses, so keep that in mind. It can help insure you against outliving your resources, which they could easily happen nowadays as we tend to live longer. So that's something to keep in mind as well. You can use it to fund your estate plan, including helping reduce your beneficiary's tax burden. Besides taking care of your family, life insurance can also protect your business, and that's something we will discuss further through an example. A life insurance policy can be structured to fund a buy-sell agreement, which ensures that in the event one business owner dies, if this is a partnership, the remaining business owners have the funds to buy the company's interest at a previously agreed upon price. This allows the owners to get the business while the family of the deceased gets the money. To protect the business in case of the death of a key employee, key person insurance payable to the company provides the owners with the financial flexibility needed to either hire a replacement or work out an alternative arrangement. And definitely this could get complicated. So if you are considering a buy-sell agreement or key person insurance for your business, make sure you talk with a financial advisor or insurance agent that knows what they are doing. Now, moving on, let's talk again about risk and retirement. Life insurance can be a very useful tool in retirement planning. Anyone who generally falls within any of these categories can benefit from purchasing life insurance. Now, again, we talked about the assets and outliving the assets as people tend to live longer. Now, let's move on now, I think, and look at a few of the examples. And let's start with Jeff. Let's take a look at a specific scenario of how life insurance can help in retirement. Jeff has already invested the maximum in his workplace retirement plan, like he has a Roth IRA and other vehicles, and wants to save more for retirement. How can life insurance help? And this is such a commonly asked question that definitely we want to address that. Well, a permanent insurance product provides both a death benefit and a savings component. The cash value portion grows tax deferred after fees and expenses. Jeff basically can borrow against the cash value in the insurance contract for a low-cost loan. He will pay a specified interest rate for the loan, and if not paid back, the death benefit basically is reduced by the loan amount. Because retirement needs differ, you may want to consult again with your financial professional that can basically look at your particular situation and advise you. This is another example of how life insurance can assist in estate planning. Anne has a business worth of $3 million. When she dies, she wants the business to pass to her son. How can life insurance help? Well, Anne can put the business in a trust with her son as a trustee and buys a single payment of $750 life insurance policy with the trust as beneficiary. When she dies, the trust takes basically $750K policy Those are the insurance proceeds that are income tax free, by the way, and pays the estate taxes. Her son is the beneficiary of the trust now and owns the business free of estate taxes. The size of your real estate determines the estate tax owed, and obviously, again, talk to your advisor about the specifics. Now, this is another one. This is another example. Let's take a look at Bob's situation. He's unable to save for retirement. Although he's good at paying his bills, how can life insurance help him? Well, Bob could purchase a permanent life insurance product with low fees and expenses, and can direct to a degree basically where to the assets are invested. He has control over that. This becomes forced savings to aid in achieving his goals. So once he retires, or even before, he can borrow against the account. Again, this type of life insurance can be an expensive type of forced savings, so be careful with that. And again, consult with a financial advisor for other less expensive ways to save for retirement. This is not a retirement instrument, but I really wanted to illustrate this example. Now, another question which is very interesting and we wanted to address before the time is up: when should you buy life insurance? The answer is ideally when you're young and relatively healthy. That's when you have the best shot at getting the lowest rates and paying less for coverage. If you wait until later in life, medical problems can increase your monthly premiums, or worse yet, prevent you from buying a term life insurance policy at any price. That's why when it comes to buying term life insurance, the earlier is the better. And then here are some facts about purchasing life insurance. As we previously noted, buy when you are young and in good health, because insurance premiums are based on your age at the time of purchase, and you'll pay lower premiums the younger you are. If insurance costs continue rising at the same pace, you will need to buy 5% more or more in coverage each year you delay your purchase. To keep up with rising healthcare costs, insurance companies basically increase their initial premiums on a regular basis. And then additionally, companies change and update their plans every couple of years, and the rates for new plans are typically higher. If your health deteriorates, insurance companies may charge you 15 or up to 75% more for the same level of coverage. Again, the rule of thumb is that you choose the policy's benefit amount based on the current cost of care. If you already need coverage, insurance companies may consider you uninsurable and prohibit you from purchasing a policy. So again, buy when you are young and healthy. Now, of course, make sure you compare your options. Contact an insurance agent or broker in your area that has contracts with multiple companies and can compare all the options for you. If you don't have an agent, or your agent works for one company, please reach out to us. I have contracts with over 100 insurance companies and can compare so many options for you. Now, let's review the action steps necessary to make the right choice for your insurance coverage needs. And also, one important thing I want to mention is, well, you know what life insurance is by now, right? And we went over the risk and the various types of policies that are available today and how they work. Now, let's take a moment and discuss where life insurance fits in your planning approach. As you look at the pyramid, it should be clear that life insurance can be used within any of these sections. It provides protection for the foundational retirement needs if the unexpected death were to occur to spouse or partner, and with chronic illness riders, you basically don't have to die to use life insurance. If a life policy is funded properly to build cash, then it may offer access to funds to take care of some of the discretionary needs at retirement. And finally, life insurance is ideally suited for creating and enhancing a legacy for your beneficiaries. Now, let's go over your questions. If you still have questions or something in the presentation is unclear, we want to see your questions coming in. I was trying to go really quick, so we've we don't we stay within the time frame. So if something is unclear to you, if you have questions, please ask them now is the best time to do that. And I wanted to mention that we have a few other videos and presentations on life insurance available on the YouTube channel, so please check it out. Before I get into questions, I wanted to say thank you for your attention and your interest, and we will see you soon. But those that have questions, please remain with us, and let's clarify them. Thank you.